Good afternoon, everyone, and thank you very much for joining us today. My name is Alina Islam, and I'm a mining analyst here at Red Cloud Securities. I'm very excited to present Electric Royalties to you, a company with 40 battery and critical metal royalties in its portfolio. To give you an overview of the portfolio, as well as discuss upcoming plans, we have Brendan Yurik, CEO and Director. Once Brendan's presentation is over, we will conclude with a Q&A session. So please put your questions into the chat box and we'll get through as many as we can at the end. Before we get started, I do need to mention the fine print. For Electric Royalties, there may be some forward-looking statements made on this webinar. Please read the cautionary note on page 2 of the Electric Royalties corporate presentation located on the company's website. For Red Cloud Securities, I would highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. We note that this webinar does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Please see our most recent research located on our website for Electric Royalties specific disclosures. And with that, I'll hand it over to you, Brendan. Please take it away.
Thanks for that introduction, Alina. Much appreciated. Yes, as you mentioned, I'm one of the founders, CEO, and a director of Electric Royalties. This is a company that we started up 5 years ago, and we went public in June 2020 on the back of 3 transactions to get our first 11 assets. We now have exposure to all of our target commodities. We are really the only clean energy metals focused royalty company out there that targets all of these different metals, including cobalt, copper, graphite, lithium, manganese, nickel, tin, vanadium, and zinc. And so all these metals are really required for not only electric vehicles, but renewable energy, which is definitely going to be a big portion of the demand over the next couple of decades, as well as energy storage, which is really a sector that's just kind of getting off the ground. And, when I think about energy storage, I really think about these are really batteries for cities. So you can imagine, the amount of metal required for that versus, a single car. We really picked these because we see really 2 decades of growth, where you have exponential growth forecasts across all these different metals. By staying diversified across all of them, really tying ourselves into that broader clean energy transition. So we went public 5 years ago. We are now up to 40 royalties, 72 assets overall. So in addition to our 40 royalties, we actually have 32 properties, 29 of which are optioned out to third parties. And so we expect about $1 million in option income over the next 12 months and a little bit under that over the following 12 months. And then hopefully those will become royalties as well. All of our royalties are in low-risk jurisdictions primarily. We have 1 royalty in Madagascar for graphite, past producing mine, a bit of a special case. But outside of that, all of our royalties are really in Canada, the United States, Europe, and Australia. So really trying to pick those best deposits for each of these metals that could fit the bill to be a domestic source of supply for these metals. And I think when you look at that over the last 5 years, we've really picked up a lot of the best royalties on a lot of the best clean energy metals assets at home. Cash is, admittedly low at the moment. We've got a very low burn rate. Our average burn rate is about $1.5 million a year. That includes, our cost of doing deals and all that. We will have to raise some equity, at some point here in the near future, definitely. But here's why it's not such a big concern. We have a facility with our largest shareholder. It's a convertible facility, converts into shares at a much larger share price. We don't owe any payments on that for the next 3 years. So, the plan would be in a better market, we raise some money, pay it back. There's no early repayment fee, but we still have $3 million available on that. And so we are actively looking to acquire a cash flowing royalty with that. And, definitely think in the near term here, you will see that. Looking to really fill in our cash flow profile for the next year and a half. Market capitalization. This is the craziest one. This is why there's a great opportunity for everybody that's listening in. If you can believe it, our market cap is under 20 million today. We have royalties in our portfolio that have forecast cash flows, 7 million a year across 48 years in the case of Battery Hill. And that's one of 72 assets in our portfolio. So hopefully by the end of the presentation, everybody else will agree, on our undervaluation. I'll just mention this, why we are there. So my family owns about 16% of the company. Our largest shareholder, Stephen Gleason, owns about 28% of the company. Most of that ownership interest was actually acquired in the open market. Building this portfolio out the last 5 years, we gave out over about 12 million in shares in terms of cost. And all those shares came back, hit us on the open market. And I think that has a real big impact in terms of where we're at today. But we've actually, managed to buy all those shares back really over the last couple of years. So definitely well placed for a move upward. So I won't talk too much about the battery and metal supply space. I think we definitely see it on the demand side. Whether it's electric vehicles, energy storage, renewable energy, the general urbanization of cities everywhere. I think there's going to be a big demand for all these metals, and it's going to be very tough to keep up. China controls a lot of these. They produce 99% of the manganese for the EV space as of a year and a half, 2 years ago. They definitely dominate the lithium processing industry, the tin industry. And so, I think there's going to be a big push for domestic sources of supply. But that's where we really see the big upside. It's not on the demand side, it's really on the supply side. And there's a huge lack of supply coming for all of these different metals. Lithium, maybe there's supply out there. It's more about where advanced supply would be. But for most of these metals, especially ones like tin and zinc and copper, where we've been looking over the planet for 100 years, the supply side is really the side I think you have to have special insight to, but where we really see prices rising over the next, couple of years. So I won't go through this slide as well because that's all kind of touches on it. But as I mentioned, everything we use today really requires all these different metals. And so they're really, future metals more than clean energy metals. And as the world accelerates towards this, we're going to need to, up production exponentially. And the average development timeline on a mine is, 15 years. Most of the capital has been going into building battery plants, which is, ironic because it's about a 3-year build period. But there's definitely going to be a lag, in terms of supply, which means higher metal prices, which means our proportional revenues that we expect to go up directly proportional to metal price increases. So great space to play in, clean energy metal space. What else is fantastic about our company? Well, it definitely has to be the royalty aspect of it. I don't think there's really a better way to play mining. I think the biggest thing to that would be diversification, first off and foremost. We're diversified already across 72 assets. There's no one asset in our portfolio that makes up, more than really 10% of our value internally, to management. So there's definitely, a de-risking aspect to it. Our royalties are also tied to the property in most cases because we deal in good jurisdictions. So that means even if the operator of the company goes bankrupt, they aren't able to, the CapEx doubles and for whatever reason they lose the project, our royalty is actually going to stick to that project. And so whoever takes it on and forward is still going to honor and have to pay our royalty. We get leverage to commodity prices. We get leverage to exploration upside. If they produce more, we get more income. But the nice thing is once we buy these royalties, we don't have to put up any more capital. So we've had partners have raised, over 700 million in the last, 5 years since we've acquired these royalties. That's all gone in to develop these assets at no cost to us. We're not on the hook for sustaining costs. We don't pay for exploration. And, when we actually are getting our revenue, we have no cash costs on that. So it's 100% revenue back to the company. And then you basically divide that over your G&A, which is very low. As we grow, the nice thing is, as a royalty company, you don't have to build out a huge team. Franco-Nevada is probably the biggest group in the space, maybe actually Silver Wheaton these days, but Franco-Nevada had, 25, 30 people working there. And they were, maybe 25, 30 billion market cap. So lots of different upsides to the royalty space. Definitely a good way to play mining, given the risks and given the benefits of diversification. So anybody who wants to, figure out and do calculations on what our expected cash flows are, expected, it's very, very simple. Basically take the royalty rate on our project. We have 40 royalties. You should definitely be able to find that. Annual production expected of the project. So that's pretty simple. The company would definitely put that out. And then you guys can pick the metal price, and you multiply those three together. That basically equals, our expected revenue income from each royalty over a year. And most of our royalties are gross revenue, so it's really nice, especially in the battery metal space. That means there's no real deductions from that. It's right off top line revenue. And that's because we're one of the few royalty groups out there that actually creates these royalties new. And that really entails going to these companies when they need money, and you're offering them capital to help advance the project. And in return, they're giving you a royalty, which is a percentage of cash flows from that mine, really in perpetuity in almost all cases. So we've got a really good lithium portfolio. We're a little bit heavy in lithium right now. We're definitely transitioning more towards copper over the last 4 months. That's what we've been focused on, and definitely is going to be our focus over the next kind of 4 or 5 months. But we have a fantastic lithium royalty portfolio. We're one of the first groups out there to be buying these royalties. A great example of that would be Seymour Lake, which we picked up, going back about 3.5 years ago now. We paid about $1 million in shares. They've got a feasibility study coming out in the near term. They've raised, I think it's over $70 million since we bought that, doubled the resource. The economics on that, the payback will be a multiple of what we paid each year once in production. And they're definitely, that has a good chance to be the first lithium project in production in Ontario. We've also got royalties in and around pretty much every major lithium project in Ontario, as well as royalties in Quebec, specifically on the Oche mine, which are soon to be mine. It's part of the Canada Lithium Hub, which is in production. Those guys are actually just in the process. They just announced a couple of days ago. They're going to be merging with Piedmont Lithium, but they've been in production for about 6 months. They have a feasibility study that basically states they want to blend 33% of the ore from Oche to meet their production targets. And so that could be in production as early as next year. And then we also have a royalty on Canset as well, operated by Winsome Resources. Great project, great company. And so, we definitely have great exposure to lithium all in and around Ontario and Quebec. So I mentioned Oche. This is one of our royalties that has a good chance to be in production next year. They had a feasibility study. This was supposed to be about 33% of the ore from that project, and has been operating, fantastic story. When we first bought this royalty, I think Sayona was about a $5 million market cap. They were up to about $2 billion, a couple of years later. They've definitely come down a little bit, but, incredible growth since we've actually acquired this royalty, and all of that really at no cost to us. So another, I guess, big reason why the setback in price over the last year, we had some really bad news on 2 of our royalties. And I say really bad news, but it was really temporary bad news. We had our 2 producing royalties shut down, both for unrelated reasons, in November of last year, 2023. And that was about, $1 million a year in revenue we were expecting across the 2 of them. This is our zinc royalty. It's owned by Trafigura. We definitely expect this to come back in production. They have germanium and gallium credits there, so there's a real big push by them and the U.S. government to upgrade their processing. So I believe that's in the works. They shut down when zinc prices were much lower than today. They're about 20-30%, I believe, lower than today. And that was the reason. This is a mine that has been kind of intermittently in production over the last 50 years, and it really is a swing producer. So zinc prices are up. We expect them to do that, and I believe they're also upgrading their underground mining fleet. So that one we hope will be back in production next year as well. But definitely at some point, it's vertically integrated with the Clarksville smelter, which in Tennessee, which is the only primary zinc producer in the entire United States, which is kind of crazy. In addition to that, we also had our producing tin royalty also shut down in November. That was due to a permitting issue, and they're working through that still. And going through some financial, issues with that. But it's really unfortunate because it was Europe's only producing tin mine. So we do expect that, there should be some kind of strategic status eventually given to this project. But as they work through those issues, tin prices have gone up over 50%. And so, if this was in production, we would definitely be enjoying, over $500,000 a year cash flow, probably even closer to $1 million at these prices. But we hope that will sort itself out here, and that Europe will be able to permit its only producing tin mine back into production, at some point here in the next year. So beyond those, I will say that, right now our focus over the last 4 or 5 months has been to go add a cash flow royalty. And so we are definitely going to do that. That will be the next deal that we do. We're looking for something really to add about $1 million a year in cash flow. And we want to be more exposed to copper. So we're definitely looking at copper assets. And, with our cash that we have to play, that'll be our goal. The reason that's our goal is because that'll really take us to cash flow positive with, our option payments that we have, very low burn rate. That'll take us to a cash flow positive level, which is a big goal for us. And partially because, if we look into the future and forecast, 5 years out, we see this annual cash flow potential for the company being, higher than our market capitalization today. And that's like on an annual basis. So, and that's really due to a lot of our development portfolio that we have. So, ones like Battery Hill, the PEA on that was 48 years, and it was kind of $5 to $7 million a year for our royalty interest on that once in production. They've got a pre-fees underway. That'll be a real big catalyst for the company to be able to get a partner in, which will be needed. But that's really the best manganese asset in Canada for sure. There's really only 2 in North America that I think are really good candidates. The other being South 32 in the US, but really a top tier manganese asset in North America. We have our Mont Saucier asset. This is fantastic. They're partnered with Glencore. They've got initial indications already for up to $500 million of export-import bank financing out of the UK. I believe it's really the best iron ore development project in North America right now, partially because of the vanadium byproduct credit. And so this is a long life asset. I think the initial PEA had a 40-year mine life. The revised one just with, I believe it was M&I was about 20 years. They're funded for feasibility study. That should be out soon. That'll be definitely a big contributor for a long time for us in the future. And we have our Zonia copper asset. I love this asset. They actually just really increased the resource, close to doubled it. Not quite though. The feasibility study should be out by the end of next year, and it's a great project. It's low capex. It's copper oxide. Very few of those projects left. It's in Arizona. But a very simple project and something that we're really excited about. When they add 500 million pounds of copper, just an example, and they didn't just quite that, but if they did, and let's take a $4 copper price, that's an extra $2 billion of value. And so what that means to us every time a group has exploration success, we have a 0.5% gross revenue royalty on that. So we expect that over its life, whatever that may be, that's kind of like an extra 10 million in potential revenues, back to us. And so that's really the exploration upside, just to kind of highlight that. Seymour Lake, this one as well. This is going to be a very big royalty, kind of on the size of Battery Hill, but a little bit shorter life. But that should be in production sooner. Feasibility study is targeted for next year. And they've been raising a lot of money over the last little bit. They've got some new partners. I think it is on track to be the first lithium project in Ontario in production. And so definitely excited about that. Graf Mata, this one's, the only royalty in our entire portfolio that has a cap on it, which is unfortunate, but this has the potential to be a really good royalty for us for the next few years. It was already in production previously for about 18 months continuously. They shut down when COVID happened. Management's right now in the process of trying to ramp that back up into production. But that would be a really nice royalty for the next kind of, 2, 3, 4 years. Kind of hoping to be about $1 million a year once back in production. But so that would be a really nice one. They've been working on the project financing. Hopefully they can get that sorted. The Random Nickel project, this is really exciting. We acquired this back when it was still a private company. Since then, they've gone public. They are now operated by Kinrose Mining, which has earned in 51% interest. Kinrose Mining has a ton of cash. They've got, I believe, over 23 million or so. They've also got a partnership with BHP. They were one of the first recipients, I believe, of BHP's Explorer program. And so they are now partnered with BHP, searching extensively across Scandinavia in and around the Rana project. And so, very exciting to see that. And then Biscuit Creek, this is the first graphite royalty financing ever done. Northern Graphite would like to make this their flagship asset. It's probably the best asset they have in their portfolio. Be a very long life asset. The feasibility study was initially done back in 2012. So, they've got a PEA on the expansion case. Now they're looking at doing a case of up to 100,000 tons a year potentially as part of a JP project. But the funny thing is that's production rate upside as a good example. When we bought that royalty, they were talking 28,000 tons a year. And now they're talking about potentially up to 100,000 tons a year. So, outside of us, since we bought that royalty, now we expect, if they hit that, our royalty revenues will be 4x, what we initially bought it on. So that has potential to also be a big royalty. We have advanced royalty payments on that for this year as well, about $100,000. And I believe they're targeting, 2028 for that one. Beyond that, we've got a massive portfolio. Like I said, there's 72 assets in here, 40 royalties. I won't go through all of them today, but we have great ones like Millennium that is partnered out with another group. We've got Sleetat, which is really in the USGS's own words, is one of two potentially economic tin deposits on the entire United States. Graphite Bull, I haven't touched on all today. This one, we acquired that. That was a historic resource. They're now, done a lot of work on that in the last 6 months, 9 months, sorry. There should be a PFS out on that, in the next year or so. So, definitely a lot of developments coming across the portfolio, royalties in and around all the great lithium projects in Ontario as well. And with that, maybe I'll open up to questions, unless...
Well, thanks, Brendan. That was a great presentation. So just as a reminder to our audience, you can type your questions into the chat box at any time. So Brendan, we've got a couple of questions. Maybe I'll start off with, can you maybe clarify what a gross mining royalty is?
Yeah, so it's gross revenue royalty. But some people, these are negotiated and drawn up by a lot of different people. So sometimes you have gross metal royalties, gross metal value royalties, but typically a gross royalty would be straight off top line revenue.
Okay. Okay. So a question, sort of broader macro environment on lithium. So do you see current lithium royalties coming online being economic at current prices, or would we have to wait for the price to come back to second or third quartile of the cost curve?
Yeah, that's a good question. I think, lithium supply demand, if you look at China, they have probably the highest cost mine out there. And if you took that offline, that'd be about 5% of global supply. And all of a sudden you'd be back in a deficit. And that's because the market's so early. So you're going to see that. I think people forget lithium prices went up by about 19 times over the course of, a year there. So they've definitely come back. They're still, I think, about double where we initially were looking at these projects, where a lot of the feasibility studies were done at. Now, I think inflation's definitely eaten into that. But, around these prices, I think you can make a go of it, in Eastern Canada. I think there'll probably also be some incentive to have, offtake prices maybe help out with that a bit. At the end of the day, these groups are going to want a reliable, safe supply, for a long period of time. And I think, the projects we have royalties on are perfect for that.
So as a follow-up to that, where do you see the long-term lithium price?
That's a good question. It's going to be fluctuating, I definitely think we'll see, maybe not 19 times like we did, earlier, but I definitely think you'll see a few jumps up from where we're at today. It seems to me like we're maybe, kind of at a bottom, but I'm not going to take too many predictions on pricing. And I think the way that we built this portfolio is really to be diversified across all these different metals. And so the way we look at pricing and when people are really down on these metals is that's usually a good time to go pick up royalties on them. And so when we picked up that portfolio last year, buying royalties really on all the major projects in Ontario for a cost that, we actually expect we'll make money back on that deal. That's the kind of deal that you definitely would not have been able to do 3 years ago, where lithium stuff was going. People were selling projects with nothing for $50 million. So, so that's kind of, I think it's more opportunity, I think, for us than concern long-term on pricing.
Okay. Next question here. Do you see tariffs being a net benefit to the North American clean metal portfolio? Do you see more funding from the new U.S. administration?
I definitely think there's going to be more of an impetus finally to have some security of supply, really, because that's kind of gotten into an insane level. And you just look at, what China did investing in Indonesia, the billions of dollars they've done, and now they've basically got a nickel industry there as well, dominating another key metal in the supply chain. I think there's going to be a big push for that from this administration for sure. I think the tariffs thing would be funny to see. I think a lot of that's going to be bluster. I don't know if people ever saw, but I thought it was interesting. A lot of groups are already deciding to reduce their imports from China, without ever having to put these tariffs in there. So I think that might be part of the play. But ultimately, I think long term, we've got assets in North America, Europe, Australia, and you have China, who's basically going to be starting to restrict these metals, I think, more and more. So I think that's kind of a bigger impact for us than maybe the tariffs will be, which would probably be a shorter term thing, I'd imagine.
Okay, what royalty do you see coming online next, and which one are you most excited for?
Yeah, well, I'm excited about a lot of them, to be honest with you. We have, I think, 10 to 12 of our assets that could be in production, in the next 5-6 years. And so, obviously I'd like to see, maybe a Seymour Lake or Battery Hill come in, because that would be, 6-7, plus million a year. So those would be a really nice, kick for us, but really excited about all of them. I mean, quite frankly, I think most excited about the next deal we're actually going to announce and buy, because that'll be a producing royalty and that'll be at cash flow right now today. So, hopefully we can share something, on that in the near future. But that's currently the one I'm most excited about, because it's the most urgent. If you look at the rest of our portfolio, I think we have Oche, Graf Mata next year could be in production. You could have MTM in production, back in production, sorry. Panuda has a chance to come back production as well. So multiple different royalties. And then from there, it'd probably be Biscuit Creek and Seymour Lake, and then Zonia, Montsossier would probably be the next kind of 4 up. So. Okay.
Looking back, what do you wish you had done differently over the last 1 to 2 years?
Yeah, well, that's a good question. I'm excited about all that stuff that we picked up, but it's obviously been pretty brutal for us share price wise. So the market definitely hasn't appreciated it. So we haven't raised any equity in the last kind of 2.5, 3 years, because we've had this money with our largest shareholder to go ahead and keep doing deals. We probably should have raised a bit of equity during that time just to bring some new shareholders in. We definitely cut back on marketing a bunch as well. So we've done almost no marketing. Red Cloud's the first group we've hired in, I think, 2+ years. And that was because we were creating new royalties for $1 million a year, and marketing budgets can be quite expensive. So, but that's also kind of hurt us a little bit too. So, those are two things I might have done differently. I think in terms of opportunities out there, I wish we had another producing royalty in our portfolio. We're going to probably add another one after we get this, just so we have, enough coverage, enough producing royalties that we're always going to be cash flow positive no matter what happens.
Okay. Without necessarily being specific, are there any royalties in the current portfolio that you could monetize so that you could deploy the cash elsewhere?
Yeah, definitely. I mean, we've had agreements in the past where we looked at selling royalties. We looked at selling just half of Seymour Lake, which is, again, one of 72 assets in our portfolio, and we were selling half of it. And, the deal was about 4 million Canadian. Ultimately, that was right around the time they doubled the resource. They had a lot of really great news going out, and we didn't transact on that, but I think it's a great example of what we could do. And ultimately, I'm happy we didn't do that one at that time. But, given where our valuation is today, after we get the deals that we have kind of looked in place here for the next month or two, that's definitely something that we're going to be taking a look at. Definitely.
Okay, Brendan, you talked about copper during your presentation, but
I'll just mention too, the manganese one. Once I get a PFS on that, that'll be a good one too. If you look at Ryan paid like $50 million for one on a European asset. I think our royalty is better than that. So well, that's personal opinion. So, but there's definitely a lot of royalties in there that we can monetize. The key would be to do it. Typically, you want to have a PFS or beyond, because then all of the big royalty groups can play. So we typically like to play outside of when they are. If we PEA and below, they can't play. So I love those. Those are the most value creative deals. Anything less than 15 million, really, you can play production wise. But to sell it to them, you really want it to be in that category. So PFS and onwards, really.
Okay, Brendan, you talked about copper during your presentation, but aside from copper, what commodity are you most looking forward to in the medium term? So that would be 3 to 5 years.
Yeah, so tin and zinc are really the other two ones that we're making a big push on, and we're going to be adding to, I think, this year. I've been pretty consistent on that. I mean, we wanted to make a big push in copper over the last kind of 4 or 5 months, and I think actually we're going to have a bit bigger window to play in copper. I really thought that'd be shut by this September because of those tariffs things. Like I said, the kind of the opportunity. I think we'll have maybe another 4 or 5 months, but tin is probably my favorite in terms of the supply side. And zinc, I think, is actually going to surprise everybody too. It's very big metal in terms of annual demand. Very few people actually interested in it, but all of the major producers that produce zinc, all of them are extremely bullish on zinc. I think it's a great indication of where zinc's going to go here over the next few years.
Next question here. What do you think of the large nickel deposits in Canada? Are you more bullish on the larger sulfide deposits, or do you see the polymetallics as more competitive?
Yeah, so if you look at what we did, we went for underground nickel projects. Stuff that was kind of small, relatively easy to put in production. I think the biggest challenge with some of those is the capex. And I forget exactly what Dumont's capex was, but I think it was 8-9 billion, something like that. And I can't remember the last time you've seen any projects raise that kind of money. That's a huge amount of money to go into a project. If you had a doubling of the capex on that would be tough. I think it's tough. I think the nickel market, honestly, is in a new environment. So, we're not really looking to add too much in terms of nickel exposure right now. We're happy with what we have. We obviously decided to choose something a little bit different, something that if nickel prices go, these could be brought back to production relatively quickly. And so I've kind of a chance to make it back to production first. I think for those mega projects, you really need to see and have eyesight on a 20-year period of decent nickel prices, because they're lower grade, much bigger things, and the payback will be much longer. So, I think it's fundamentally, at least for the next few years here, should have seen it coming. China investing billions of dollars in Indonesia over 5-10 year period, right? But all that coming online now, it's definitely shifted it away. So I think it'll be tough. Pricing wise.
All right. Can you provide an overview of your criteria for choosing companies to invest for projected royalties?
Yeah, so typically we actually start with the asset first, because if we're actually going to go create a royalty on this from scratch, that means we can pick it, which asset we want to do, and because most of the royalties can stick to the project, that can be definitely a consideration. As you get closer to a producing situation, management team becomes way more important. I'd say it almost becomes the central piece of it, because there's very few groups out there that have actually built and operated mines, and typically I don't think we have yet. I don't know if I would, but invest in somebody that doesn't have operating experience at an operating mine previously. And so that's definitely, it's funny as you go and go easier down or further down towards production. It kind of changes the focus up, but typically we choose the assets we want to be a part of, and then go in and negotiate something.
Okay, question about the slides being available, and I believe they are on your website.
Yeah, they are.
Okay. Question. Sorry, go ahead.
So is my contact info. I believe it's on the back of our presentation as well, and so please feel free to reach out.
Question on valuations, Brendan. How do you see royalty valuations generally in the long term? Are streaming deals easier to do than royalties? Streaming deal. Yeah, we announced our first kind of streaming LOI just about a month and a half ago. I like it. They're different. They're easier from the perspective of you have security, usually, like it's a debt instrument. And so really you just are looking at the assets, the value of it. You take security. It's nice because you can really forecast the cash flows, typically a lot better. And the TSX will actually let us forecast, copper stream cash flows. But you typically don't have that long-term upside that you do from royalties. So you're missing out on some of the exploration upside, production rate upside. They're also much more highly leveraged to prices. So, whereas like if copper prices go down 10%, our copper royalty income would go down 10%. For copper prices on a stream, if it went down 10%, it could be a much bigger impact. You might lose 30% or 25% of your revenue. But on the flip side, if copper goes to $5, all of a sudden, your deals may be making 50% or 60% more. So it's much more highly leveraged, different for sure. I think royalties are tougher.
to put together from a technical standpoint of just making sure they're secure, getting them against the property and all that from a negotiating standpoint. But both good. We're definitely going to do some more streams in the future, just partially because of that forecasting aspect to it, being able to forecast cash flows, to the exchange, to investors. Even though royalties, we have our forecast cash flows, we definitely have our internal forecasts. They're trickier from an exchange perspective.
All right. So does Electric Royalties have an in-house geology team, or is it outsourced depending on deposit type?
Yeah, so definitely we call in people depending on the project for sure, especially because it's clean energy metal space. So, you can't have somebody look at necessarily your lithium and look at like your nickel and your tin and your zinc, because they're all a little bit different. And so I do have a geologist in-house. He's great. He's David Gaunt. He's done, the resources for a lot of the biggest projects on the planet, like Northern Dynasties. And so he's my geologist in-house. But typically, depending on the project, we will definitely bring somebody else in. And again, that kind of depends on, what kind of project it is. But, for a producing operation, we've been looking at down in Chile, we bring in engineers, stuff like that. So.
Okay, I think that was the last question, Brendan. Thanks a lot for taking time to host this webinar with us today.
Thanks so much for having me, Alina. I hope that was helpful to everybody. And if anybody has any further questions, feel free to reach out. We're definitely, near our all-time lows today. So good opportunity to come in for new people.
Just as a reminder for our audience, our next webinar will feature Eris Resources, and that's on November 26th at 4 p.m. Eastern. Thanks for tuning in with us, everyone. Have a great day.